owning 3 properties and a retirement fund does not equal diversification. We probably are seeing a lot of is now people doing similar kind of concentration, but going to something like, and then they're kind of putting all their chips in and backing that.
Putting all your money there, geez, I don't know if I'll be able to sleep at night. The storms will always come. I think that's probably the only guarantee we'll ever give you is they will become a storm and the markets will go up and they will go down over time. They might think they're very well diversified with their understanding on the micro level, but when we zoom out, it's like, oh, nope, we have a couple of things going on here.
You know, I kind of think of investing everything that you have into one thing is kind of like,
it's a very common occurrence that people think I've got a lot of money into certain sectors that I'm a professional in, but then when they actually realize they very much concentrated to risk. And it's very important that we map that out and to understand what diversification really means, what it's not, and when you sometimes go too far and you over diversified. And that is what we thought about talking about today, really mapping out what it means, busting a little bit of a couple of myths that some people believe around it, and at the end, educate you in terms of understanding what diversification really means and how you can use that to then better create or look at your investment portfolio.
Something we've seen with clients over the years, I don't know about you, but they'll say, you know, I've got a really diversified portfolio. You know, we start working with a family, we get to know more about them. And then they'll say something like, you know, I've got my business. So maybe I have my business and that's great. Or they're employed and they're earning a salary. So they're earning the salary in rands. Then they say, I've got 2 or 3 rental properties and that also brings income in. And then, you know, with the company that they work at, they've got a pension fund and they're invested in that. And so they kind of think, okay, well, cool. I'm diversified now because I've got different income streams, which, you know, which is great. That is a diversification of income stream. But then when you look a bit deeper, you realize that there's not much more diversification happening there, you know, in terms of asset classes and also currency. So maybe you can just kind of run through a few of the ways a person can be diversified. Like what are the kind of the big categories that a person can diversify across?
Yeah, for sure. I think one of the ways that I always like to look at diversification is, you know, if you want to build a big skyscraper, a massive building, you're not just going to use one type of material. You're not going to use cement for the whole building. Yes, some elements of the building will maybe use cement, but you're probably going to combine different materials that some have weaknesses, some have strengths, and you combine them to then erect this massive building. Because if you only use cement, maybe you'll be able to build it, but the first storm that comes, the first wind, it's going to clap your building down. And first earthquake, it's going to crack it, it's going to shatter. So when you look at your wealth and you kind of, let's say you're building a financial empire now, let's go big now, intergenerational wealth, then you likewise also not just going to rely on one skill, one asset class, one bet that you're going to put your entire portfolio on. Because when that first wind comes, that first storm, that first earthquake, which it will, it might shatter your entire portfolio. And I think one of the worst things to happen is to dedicate your whole life to building up maybe a business that you think, you know, is very successful and it's doing well. And then something like COVID comes across and it wipes out your industry. So we want to be aware of that concept and then say, right, so what materials do we then use? What combinations do we have that can actually help us better diversify and then mitigate different risks that can happen? So I think if to start off, the core fundamental of diversification is between asset classes. So I'll break it down. There's growth assets. Those are the assets that really helps you to grow your money over time. Something like property, equity, stock, shares, basically the same thing. It really helps you to bolster the returns on your investments over the long term. And then you get conservative assets, cash and bonds, which are the ones that brings a lot of stability to your portfolio. They don't give us those, you know, massive sexy returns, but they bring stability. And you need that sometimes in certain cases to weather the storms. So equity will do better than cash over the long term. Doesn't mean it's going to be like that every year. Sometimes it will be at the top, sometimes it will be at the bottom. We're not trying to predict which asset class will perform best next. We want to look at a portfolio in totality and have a combination of these asset classes in combination, like you would build a building, to know that in certain instances, these combination of asset classes will perform better, and in other instances, these ones would. And so we kind of put them together, we mix them in, and then we create a portfolio. So I would start off with the asset class diversification.
Yeah. Yeah, exactly. And there's various ingredients to the kind of the cement mix, the construction site that you painted that picture of. It's going to be bricks, it's going to be the cement, it's going to be everything else in between as well. And so, I kind of think of investing everything that you have into one thing is kind of like relying on one outfit for the rest of your life. So if it's like a tank top or a vest or something and board shorts and pluckies, you're probably going to get through summer okay, but 3 seasons of the year, you're going to suffer. You're just not going to be appropriately dressed. And so if you invest everything in property, for example, it's highly cyclical. It really is kind of a signal of the economy. And so when the local economy is not doing well and you're invested in properties, you're going to suffer financially. And that could last for a long time. It was, I think, 2017 or something like that. I can't remember now, but the listed property sector in South Africa, it effectively re-rated. It lost something like 20% within a few weeks or something ridiculous like that. I can't remember now. And it hasn't really recovered since then. So it was just a re-rating. People just said, this is the new value of this kind of investment. Now, if you're like a property bull and you have everything in property, a listed property, for example, then you would have suffered now. Your net worth would have dropped by like 20% within a few weeks. So that is why that whole cliche of diversification is your only free lunch in life. It's because you're spreading the risk around, and, I think maybe the wrong thing to say, but it's so common. People always like kind of use a betting or a gambling analogy with investing, and it's not the same thing. But if you think about it, it's like taking everything you have and putting it on one horse. It's not really maybe the cleverest thing to do. You probably want to spread those bets a bit. And so, yeah, having bonds, cash, equities, which are company shares, property involved, then you start spreading it out. And also private equity, like owning pieces of businesses directly, whether it's your own business or other businesses as well. And I can give you an example of this where it would have been risky to go all in on something. And that is, a couple of the clients that we have, they have extensive property portfolios. Now, unfortunately, in South Africa, in the Western Cape, property does very well. Residential property, I'm talking about. Rentals go up nicely every year, and the value of the properties go up nicely as well in terms of capital growth. But in other parts like Gauteng and that, it's not necessarily the case. Like it used to be, but it's unfortunately it's not the same anymore. And so I do have clients who have extensive property portfolios in that part of the world. And so they haven't really been able to increase rent for about 5 years. So since the beginning of COVID, the rental, they haven't been able to increase. In fact, they've told me that if a tenant leaves, they have to reduce the rental because they're actually now charging old rates, which are above market. So that's the first thing. And then when we do their planning and we try and project the value of the properties into the future, we're putting growth rates of 0% or 1% a year on the capital value of the property. Now, the clients of mine, very fortunately, we've ensured there's a diverse portfolio. So they've got this business that runs these residential properties. They've also invested in the index. They've got trackers that they invest with every month. They've also got other sorts of investments. There's traditional retirement funds and so on, the tax-frees and all of that. So they're very well diversified. And so this isn't really hurting them too much. It's not ideal that like this investment is not flourishing. It's not amazing. And in time, they might start exiting some of these positions, but it's not going to ruin their financial futures. It's because they have such diversification. So I can only imagine that if they were kind of property bulls, like they just went in on property and that's all they were in, it would be a very different conversation. It would be very sad now. They would be selling properties at losses on that, and their income wouldn't grow with inflation. So, I mean, I don't know about you, but I think something that we probably are seeing a lot of is now people doing similar kind of concentration, but going into something like crypto, for example, and then they're kind of putting all their chips in and backing that. I mean, surely there's some massive risks with that as well.
Absolutely, I agree. If we look at how the asset classes have performed over time, you get like the 2015 SA real estate listed property almost received a 40% return. It's a massive year. But then if we fast forward 5 years later, COVID hit, minus 45%. That is a massive, I mean, that's effectively 85% difference in returns. Now, if your entire wealth is concentrated just on that sector, it will give me a massive heart attack if I were to see that happening, and I think when it comes to money, there's the knowledge side, the technical side, how we do calculations, where we put our money. I think that's the easy side, because when it really becomes tough is the emotional side, the emotional kind of connection we have with our money and with our assets, especially when it comes to property. And hence why we sometimes make the biggest mistakes. And I see that all the time with clients before they come to us. They usually went through a period where they panic sold investments, and then that's usually when they make the biggest mistakes. So we want to try and mitigate those massive swings over time to make sure that you keep with the plan, because the plan is only as good as you keeping through with it. And yes, there's other, like you mentioned, crypto. It's all the hype, at some stage what was in NFTs, someone sold these digital art for, the most expensive piece of art in the world. I think now it's worth like maybe $100. The world went crazy.
That monkey thing?
I think it's Bumble. It's like a collection of NFTs, like a massive painting that was sold, but now it's basically worth nothing. So it's important that we don't follow the hype. And yes, crypto assets is a regulated asset class now. For some people, it would make sense to incorporate that in a new portfolio. It's still a relatively new asset class, so it can add value, but within a diversified portfolio, usually like 2 to 5% in most cases. So, but putting all your money there, geez, I don't know if I'll be able to sleep at night. And yes, you might be right. There might be people that do that, and then 10 years later, they're like, look at me. But the problem is, very often you're not. And it's in those moments where you're not right, where you make mistakes, and where mistakes hurt, especially if it's going to influence not only you, but your family and your family's family, like your extended family.
Yeah.
You want to make sure that you can sleep better at night, and being smart about how you position your portfolio to weather the storm, which will always, the storms will always come. I think that's probably the only guarantee we'll ever give you is they will become a storm, and the markets will go up and they will go down over time.
Yeah,
and we need to be prepared for that.
Yeah, exactly. I mean, and being prepared for it is the tough thing. I think when it just kind of dawned on me, when you do go all in on an asset class, it's what you kind of we would refer to as a high conviction call. I have high conviction that, I don't know, let me just make something up, like gold. It's going to be gold now. And I liquidate investments, and I put all the money in gold, and I buy gold, and I store it somewhere. And I'll say something happens and gold is not what it once was. So now your wealth has eroded. You've, jeopardized your future, maybe the future of your family. But it's often people who go all in on something that they have these kind of heroic stories of like success. I went all in on tech or AI or something, or crypto, and it worked out for me. But what we tend to find is that for every story like that, there's about 1 million stories that are the opposite. For every success story where someone's at the top of Everest, there's like a whole mountainside of corpses, unfortunately, like a terrible picture to paint, but it's just the reality. And so that is what we see financially. And that is why, when you look at the wisdom of the Charlie Mungers and the Warren Buffetts of the world, they got wealthy very slowly, but it was like diversifying, buying good companies, buying shares regularly every year, slowly but surely. And now you think, oh, they're billionaires, but they weren't at 50, but it happened over decades. And so that's kind of the emotional side of it, where people need wealth now. And then it's like, well, that's going to take me 30 years. Let me go all in on something. Unfortunately, not all of us will have a book about us or a movie about us and about how we went all in and it worked out. The guys that lost all the money, they didn't have the movies and the books. And those aren't nice stories to talk about. But I think over concentrating, you run that risk of losing everything. And so that's why when I mentioned earlier on, maybe a bit provocative, but if you have your business or whatever and a retirement fund, or you have a few properties and just a retirement fund, you might think you're well diversified. But the one thing I can pick up there is that, and maybe you can run with this, but firstly, then everything's in rands. Currency diversification is a biggie, and that's something we obviously, you can talk about that, but that's something we focus on with clients as well.
It's a massive one, and it comes from our home biases. We South African, we were born here, we were raised here, we live here, we work here. Everything is in rands. And yes, you may be very successful. Maybe you have built a big business. Maybe you do own a property portfolio. Maybe you even have investments invested in South Africa. But now, what we now need to take into account, you concentrate, if everything is South African, invested in South African companies in rands, you massively over-concentrated to one currency, South African rand, to one economy, South African economy, and to one region, maybe Africa. So yes, South Africa can turn around and become very successful. But if we look back over the past 10, 15, 20 years, the rand is consistently devaluing against the major hard currencies, the dollar, the pounds, usually between 4 to 6% per year. When I was born in 95, the rand was, I think, around like 3 rand against the dollar, if I'm not mistaken. We're now brushing 18, 19, 20 rand. So we feel it when we go overseas, when we have to buy stuff that are imported, things become more expensive. And just by nature of being a third world country, if our average inflation rate is 4 to 6% and the US is 2 to 4%, there's going to be some currency devaluation. Whether it's not a hit at South Africa and saying we're a bad country. It's just because of the dynamics of how we fit into the bigger world picture. So if the rand continues to devalue against the dollar, everything will become more expensive globally. And if we consider ourselves as global citizens, we need to hedge against that rand falling. And there are many ways to do that. But likewise, also, if we know that everything is just invested in South African companies, if we gooi all the companies together in South Africa, your Pick n Pay, your Woolies, your Naspers, everything together, it makes up just 1% of the world's investable markets. So if we invest just in South African companies, we by default missing out on 99% of other companies. This is now, you guys, like, Apple, Tesla, Microsoft, massive behemoths, tech giants that unfortunately we won't see from South Africa. It's just our economy is too small. I mean, those companies are valued more than our entire country. So we want to make sure that if we invest, we want to have exposure to these countries, not necessarily because we're running away from South Africa, just because we want to benefit from different regions, different growths. At this stage, the US has dominated for a long time. They're running in the front line. Will that continue forever? Who knows? I don't. But there might be a different economy at some point. Maybe it's China. Maybe it's India. Maybe it's one of those emerging countries. Hell, maybe it's South Africa. Who knows? That we want to make sure that if that happens, we have exposure and we can join the ride. And that is why when we diversify, we may want to also go across borders to the world. And I always like to say, if you don't know what to buy for the long term, just buy the world. Because as long as we as humans continue to exist and continue to innovate, the world, the economies will grow and the markets will go up. So trying to invest and have exposure to as many companies, regions, economies, currencies as possible is a good long-term play for most people. But what we also need to be cautious is also not saying, I'm so afraid of South Africa, I'm putting everything in dollars and investing everything directly offshore. That might be a terrible idea for some people, especially if you intend to stay in South Africa. So it's a fine balance. It's not a black or white situation. But if we look at like the past 15 years, because the rand has devalued against the dollar, we see South African equities versus foreign equities. It's about a 4% difference over time. And 4% per year over 20, 30, 40 years is a massive return on your investment that you would want to benefit from. So it's holistically looking at a total portfolio and then deciding how much should we move across and how much do we keep here.
Yeah. No, I agree. I mean, we mentioned 3 or 4 things that kind of sent my brain going into the direction of conversations we've had with clients. Even recently, a client asked the other day, they said, when is a good time to move into emerging markets? We've got global investment portfolios with them. And so we reminded them that they are invested in the emerging markets because they're in global trackers. So tracker funds like the All Country World Index is a great one. You're buying the world effectively, all the best companies, or the greatest companies in the world. And so it's a kind of like, I think the lotto has that slogan, you got to be in it to win it, So, when is the best time to be in something? Well, we don't know, but own some of it. And then as it rises, your wealth or your worth that is attached to that asset class or that geography or that currency, then it will rise too. But to pin everything on one currency or one country or one asset class is very tricky. It's very risky. You've got to know something that no one else does. Now, I'm not talking about business owners. Like when you own your business and you're starting it from scratch, that's going to be like your net worth for many years. Like it will be your balance sheet is your business, and that's just life. But at some point in time, the business will produce income, and then you take income out of the business and you start investing in other things, and those other things create diversification in your life. The business isn't always going to be the only thing that kind of keeps going. You have to build wealth outside of it. And so that is kind of, when we talk about diversification, it's not like don't own a business now, because all my eggs are in that basket, so to speak. Yeah, you got to start the business, but it's going to make you money. What are you going to do with that money and that capital afterwards? Spread it around, invest in different things. And that's why I'm glad what you mentioned earlier on about these companies all around the world. The top 100 companies in the world, the top 500 or 1,000 companies in the world, it changes regularly. The order of those companies shifts, regularly up and down, up and down. So it's not about, which one is going to be the next one to be invested in. It's more like owning that index. That's kind of how we see it. At least with our clients, it's just being there, and then it will rebalance itself. The portfolio will grow along with those companies. And it's served investors well over the last however many years that they've been able to invest in these indices. And then if you're investing around the world, you are diversified across industries, because, if you invest in South Africa, you can't really invest in tech, We don't really have tech stocks, although Naspers is basically Tencent, right? So you can kind of get a bit of tech there, but it's a very indirect method of getting to Chinese stocks. But we can't really get tech. So now if you want to get in tech or renewable energies maybe, or something like that, you've actually got to go outside of the country. And another thing you mentioned, which is super important, which I want to drive home, is if you're living in South Africa and you're spending rands for the rest of your life, potentially, you can't necessarily have everything outside of South Africa. You can't have all your money outside of South Africa because, we have the rand is called the Ropey rand, and it's called Ropey because you can imagine a rope, and you take a rope and you go like this with it. It goes up and down, and the rand does that the whole time, versus the dollar. It's extremely volatile cocktail, those two currencies. And so if your investments are in dollar or euro or something like that, and you bring it back in rands, the rand could strengthen by 10% for a year or two, and now your portfolio has gone down by 10%. So the underlying shares, maybe they've also gone down, and now you're down further into a hole. And so what we find is, and this something we mentioned earlier on in this chat, is people get emotional. People make emotional decisions. And don't get me wrong, all decisions we make are emotional. All money decisions are emotional. It's just about being aware of them. But, I have seen with clients who've maybe survived a crime, survived violence. You think of the riots we had in our country in 2021 in KZN, and they survived that. They got through it, but now they want to get all the money out of the country. I think that's a natural reaction to what we saw happen, and it's understandable. It's not necessarily the right long-term strategy if you intend to remain in South Africa. You've got to have some of the money that you use to purchase things here over here as well, just to level out that volatility. Diversification doesn't mean getting out of our currency or out of our stocks. It just means including a lot more. Not necessarily 99% of everything and 1% of South Africa, but it could mean just diversifying a bit more offshore, getting exposure to the great companies that we don't necessarily have in this country. And so that is something, I have seen with clients that we have at Freedom is initially coming in with portfolios that look diversified, and then what you realize is that it's not really diversified. Everything's in South Africa or everything's in one asset class. The last thing I want to throw at you is to maybe talk about another area of diversification, which we haven't even touched on yet, but product diversification. Because something I have seen with clients of ours, a lot of our ideal clients, they're employed, they're senior managers, they're executives, they're companies, and for years they've been contributing to a pension or provident fund. And it might be massive, like 8, 9, 10, 12 million rand going into this provident fund. It's massive, it's growing. There's nothing else outside of that. And that's a problem. So maybe I don't know what your thoughts on that are. If all the money is wrapped up in a retirement fund, what are the blind spots? What are the concerns that someone might have?
I think that's always the natural kind of first investment for most people. If you join a company and they have a pension or provident fund, most likely you're going to contribute towards that. And if you stay with that company for a long time, yes, you're going to build up quite a substantial amount in that provident fund, which is great. You've got tax benefits, you pay less taxes by the contributions, it grows tax-free, and all of that in itself, it's a great investment product. It already has exposure to many countries. So I think, just if we say investing in a retirement annuity or a pension or provident fund, most likely it's going to have about 75% equities, 40% offshore. So that's already a form of diversification within the fund. The issue comes with just having that. Let's say maybe you've got a pension fund, you've got a paid off house. Great stuff. You've graduated the school of life. Now you retire. Now that's great. You've got a big pot of money. You can draw a monthly drawdown from that. But by nature of those types of products, they're not very liquid. So only once a year, if you convert that to a living annuity, you can only change your drawdown once a year. And then that becomes a challenge if there's those one big once-off kind of expenses. You want to fix your car, go on holiday, and then liquidity becomes a problem. So when we zoom out and we look at playing the long game, we want to have a balance of investment vehicles as well. We've got our retirement funds. That's great from a tax perspective, not only paying less income taxes now, but also falling outside of your estate, saving on estate duty there. But you also want liquidity. You also want something like a tax-free savings account. That's almost like a retirement annuity, also grows tax-free. And you're going to kind of treat it like a retirement fund. You're only going to access it later on in life, but it brings a lot of liquidity to you. Maybe a discretionary investment, maybe some endowments, because that also in the totality of a portfolio, you want the tax benefits of retirement funds, but also the liquidity aspect, so that when you get to that point in retirement one day, you've got options, you've got flexibility in your portfolio. And I think that's a big one for me is understanding we've got investment vehicles, which is the kind of wrapper we put our money in, and the assets, the funds that we put in there, we can diversify, but also between investment vehicles, with each one bringing its own benefits. Some comes with tax benefits, but not a lot of liquidity. Others come with little tax benefits, but with a lot of liquidity. And the way we try to approach financial planning with our clients is we zoom out and we look at the holistic picture and then say, all right, based on what you want to achieve in life on a macro level, this is where we want to head. Right, so let's reverse engineer back to today and look on the micro level. How are we positioning each little piece of your portfolio? If we play chess, where we put the king, where we put the pawn to get to that point in life. And that sometimes mean that we want to have more than one investment vehicle that serves different purposes in the kind of holistic approach that we want to achieve in time.
Yeah, I completely agree. And that is why as soon as, I joined the financial advice sector all these years ago, and I started working with clients, I realized that the conventional wisdom, the wisdom of contribute as much as you can to your pension fund, it's actually kind of rubbish, to be honest. It's really rubbish. And I'll tell you why. And it's because of the L word you mentioned earlier on. And the L word is liquidity. Yes. If you want to live a nice life, it doesn't just rely on a monthly income. It relies on also capital purchases, or what we call lumpy payments. And so if you can think of a smooth payment is something that comes out of your monthly expenses. So, if you're retired, you get a pension every month that pays from one of your investments or something, or if you're employed, you get your salary. And so that pays out to you every month. And then you got your expenses that come out. So it's this kind of like smooth line of cash flow that you've got going through your life. Every now and again, you need to open that tap a bit bigger and like just quickly and get a whole cup full of money. And you need to buy those tickets to go abroad. Family of 4, 150K, there we go. That's Europe for 2 weeks. Now, you can't take that out of your salary, right? So you need money. And then some people get to retirement and they think, okay, cool, now I've got 12 million, 15 million in this pension fund. Yeah, but now that's all you've got. And so now you can't go to Europe to visit your children who've probably emigrated or something. And now it's like, what are we going to do? Well, I need to take more money out of my monthly salary from my pension, and then you just pay a lot of tax. Now you can do it at retirement. You can take a third of your pension fund at retirement. But what you're going to be doing then is donating a hell of a lot of money to the government, because you're just going to be so much tax when you take that out, especially for larger amounts of money. What we have seen with clients is when they had all their money in pension funds, they had to withdraw at effectively a 36% tax rate to take out the million or two that they needed to have cash available to buy that retirement car, to buy whatever they needed to, and have money aside for healthcare in retirement. This is age 65, 36% tax. So retirement fund contribution, it's not a tax deduction permanently. It's a tax deferral. And so you've got to have money outside of retirement funds, even from beginning. 25, get your first job. Maybe don't put everything into the retirement fund. Or, you probably might have a compulsory contribution, but then try and keep some money aside to keep outside of it. Because if you want to live the nice life that you want to live, maybe it's going to a Formula One race every year somewhere in the world. You need those airline tickets. You need the money. You can't rely on your pension salary for that. So keep the money outside of just a retirement fund product. And that's why, at Freedom, like what we do is we look at a person's balance sheet in terms of asset allocation and in terms of product allocation, in terms of currency and geography, all the asset classes, and we kind of measure that out on like a not a scorecard per se, but it's kind of like a map, and we map it out and we look what it looks like. And so, if I look at 10 or 20 statements of products, it's like, okay, it looks like you've got a few things on the go. You diversified. You put that into like a spreadsheet and you realize, oh my gosh, everything's in retirement funds, or you've only got 10% of your net worth outside of South Africa. And so that is where you need to, as an investor, a South African investor, look at your finances and try and diversify across all these different asset classes that we talked about today. The different asset classes are property, equities, which is just another word for shares, company stocks, bonds. Bonds are government bonds, corporate bonds. A bond means a loan. I think we all know that. We all pay that every month. And then you get cash. Cash is money market. And so those are kind of traditional asset classes you can be invested in. Then you get currency diversification. Rands, dollars, euro, geography. Are you just in Africa? Are you just in North America? Are you just in Europe? Are you just in Asia? And then sector. Are you just technology? Are you just in mining? Are you just in financial services? Whatever the case may be. It's not easy balancing all of those, but that's the kind of thing that we need to do, or we do with our clients to spread that load and that risk around. Anything you want to add before we wrap up? Words of wisdom.
Yes, I think when we make a financial decision, we always want to first take a step back and understand where we're trying to get at. And usually what then makes sense is, instead of being reactive, like I heard something on the news, the rand dropped by 20%, it's rubbish, I'm taking all my money overseas. We need to be proactive and say like, okay, this has happened. Cool. It happened in the past. It will probably happen in the future. Does this fundamentally change my goals, what I want to achieve? And in order to understand that, we need to look through the lens of like a wide lens of everything that we have. And then on that macro level, see, all right, well, maybe there's some imbalances with what we have. And usually there are, if people come to us, they might think they're very well diversified with their understanding on the micro level. But when we zoom out, it's like, oh, nope, we have a couple of things going on here. But then that brings awareness, and then you can understand what the next best move is. And then only then can you really go back into the fund level and just decide, do we make changes? Oftentimes it's kind of like a lot of confusion in the beginning, but once we map that out and we have a good strategy, And then we can build towards a cohesive portfolio that can get us to the end, that has the right mixture of all of the many things you mentioned, and there's many more as well that can oftentimes bring a lot of kind of like anxiety, like, geez, I have to have exposure to all of this. It depends on your situation, and we first need to diagnose what you have. So we want to try and introduce you to the concept of diversification, and to understand that, you know, it's good to have exposure to many sectors. And in later episodes, we're going to go deeper into each element of that and how we actually approach with our clients, how we look at a portfolio in totality. And we also have a little something that we might share for you guys watching, to help you understand what you have and how that serves you.
Awesome. Thanks, man.
All right. Thank you. See you next time.